What up, what up, what up? It's your favorite YouTuber's favorite YouTuber. That's right, y'all. It's your boy, the Options Boss, sliding up on y'all. I hope all is good. I hope you guys making some money today, and I hope you're ready to learn. So listen, today I'm going to talk to you guys about how to buy put options and what is a put option. Now, guys, when the market is going down and you want to make money, the way that you can make money when the market goes down is by buying put options, and we're going to go over that now. So make sure you subscribe to the channel, click the notification bell, and click all notifications, so when I drop these get money jewels, you'll get it first things first, right off the press, so you can put these game plans and strategies right into play the very next day when the market opens. Also, make sure you watch this video from beginning to end. When you watch from beginning to end, you're going to learn throughout the entire process, and the YouTube algorithm is going to love me, and for that, I'm going to love you. Now, guys, like I said, with put options, it's very simple. When the market is going down and your portfolio is getting smaller and smaller, the best thing you do is take that buying power, find a stock that's going down, and you buy a put option on it. There's call options, and then there's put options. Call options are what you buy when you expect the stock to go up. Put options are what you buy when you expect the stock to go down. So now, I'm going to show you guys how to do this on Robinhood. It's not the platform that I prefer. I prefer Tastyworks or possibly even Webull, but I know most people use Robinhood, so I want to walk you through on Robinhood, so this way you know what you're doing on your platform of choice. Now, like I said, guys, if I was expecting Apple to go down, this is what I would do. I would come over here and I would go to trade Apple options, and I would click on trade options. And once I did that, you're going to see it says buy, sell, call, and put, right? So what I want to do is I want to leave that on buy, and I want to switch it from call to put. Now, again, guys, this is what you do when you're expecting a stock to go down. So you got your buy, you got your put. Your expiration is 9/23 right here. You can go into it and change the expiration right in this little drop down platform, and you can change it to whatever expiration you want. For conversation's sake, let's just say a 9/30 put on Apple. The next thing you would do from there is you would select your strike price. Now, if you look over here on the left hand side of the screen, you'll see the different strikes, and these strikes all have different meanings. I'm going to explain what I mean when I say that to you. They all have different values, and they all have different likelihoods of success, so to speak. Now, first of all, Apple finished the day, or is currently trading at 157.04. So anything over 157.04 for a put will be considered an in the money put. And an in the money put is going to be more valuable to you, so it's going to cost you more money. And the reason why it's going to be more valuable is because that means that put is already at a point where it could be exercised and someone else could benefit from this contract. So when a put could be exercised and someone else can benefit from that contract, the price is going to go up a bit. So now, let's say, for example, this 157.50 put, right? If we go all the way over, you'll see on my screen that costs $4.15. Now, that's not really what you're going to pay. An option gives you the right to buy or sell 100 shares of each stock. One options contract gives you the right to buy or sell, depending on if it's a call or a put, or if it's a buy call or sell call. You get the option to buy or sell 100 shares of each stock. So, that being the case, this put option that costs $4.15 for that 157.50 strike is really $4.15 times 100. So if I was interested in that strike, in that option, I would pay $415 total for this particular play. Now, if I go deeper up into the money, higher up, so if I got the 160 put, you will see that costs $5.45. So again, it's going to get more expensive the higher up I go for a put. Now, if I was looking for a cheaper contract, I would go where they call out the money. Out the money would be below where the stock finished trading at. this stock finished trading at 157.04. So if I got this right here, this 155 put, that's considered out the money. And that out the money strike will cost me $3.10, aka $310, right? And again, just to show you a little further down, further out the money, if I got the 152.50 put, that will cost me $2.29. So it goes further down. Now you may ask yourself, how do you know which strike to get? And that's a great question. And really that comes with repetition and watching the market in general. But to give you a quick idea of how you should know which strike to get, you can always click on the strike. So we'll click on the 152.50 and we'll look down and you'll see the Greeks. And if you see the Greeks, you'll see delta, gamma, theta, vega, and rho. And if you look at the Greeks, you could see which option presents the best selection of Greeks for the price that you're paying. And once you find that out, that will really let you know which option you want to buy here. So each strike has different Greeks. This 152.50 put for 930 has a delta of -31, right? And that's the 152.50. And you see that costs $2.29. Now this 155 has a delta of -40. And it cost us $3.10. Now, things matter more than the delta and the gamma and all that stuff. Like every single one of the Greeks matter. But I'm just showing you the delta because I'm going to make a later video about the Greeks to show you each strike has different Greeks. The delta is different, the gamma is different, so forth and so forth, and that's why the premium is different. And that understanding the Greeks will help you understand which strike you should buy comparative to how good the Greeks look and how much the premium is going to cost you. Now remember, you don't want to spend too much money on one play and that play be your entire portfolio. That's never what you want to do. You always want to spend a small percentage of what you got, your buying power. And this way, if the play goes wrong, you didn't blow up your account, you still got more money to be made, and you could go forward and learn in this fashion. But each Greek, even if you change the date, if I change this back to 9/23, and if I go to that same 155 put that had the delta of 40, now the 155 put has a delta of 38 on 9/23. And instead of costing me $3.10, it's going to cost me $1.92. So you see, each strike, each date has different delta, has a different price, it has a different value. And it's up to you as a trader to be able to grasp that information to understand this is when I should buy 930 or 923 or 10.7 or whatever. This is when I should buy in the money, out the money, at the money, etc., etc. And when I say at the money, what I mean, technically this 155, this is you could say right below the money right here. This is out the money right here. But this 157.50, this is basically right at the money. That's right there. And it at the money just means that your strike is very close to the price that you're getting the stock at. So if your strike is 157.50 and the share price is 157, you're right there at the money. And that's what that term means. But watch this channel. Make sure you're subscribed, and I'm going to give you more information on the Greeks, on buying calls, on how to break down charts to understand when there's a time to buy calls, when there's a time to buy puts, things that you look for so we can learn together. Also, guys, I'm going to drop the link to my free Discord. Make sure you jump in the Discord and holler at the options boss so we can learn together, so we can eat together. Guys, you can always be a boss with the options boss. You already know I'm a holler when I holler.